Welcome to the Speaking Podcast. You can find all our episodes on speakingpodcast.com. My guest today from South Carolina in the USA. He's got 40 years plus professional investment manager advisor. He's retirement income independence coach. He's the author of 2 books. So please welcome Steve Selengut.
Well, thanks for the introduction, Roy. Pleasure to be with you today.
Yeah, no, I'm looking forward to this. And because in fairness to you, you've listened to some of the shows, and I don't kind of touch much on the money side, but it's actually a very important thing, and it's probably good timing because I've in Ireland so I'm 51. When you hit 50, you can kind of you can get your pension, you can get 25% tax free. It's simple when you want to start the pension. The amount of hoops I had to jump through, they look for everything. And I don't know, is that the same in the States? But it's painful when you want to get your money out.
Well, with Social Security, which is, I think, what we're talking about for the U.S. side, it's pretty routine. You go in, you check in, you get your IDs and all that stuff. And then they really lead you through it. And you go in about 3 months before your birthday, before you're eligible. And then by the time that comes around, your first check usually shows up the month. In our case, we were self-employed, so instead of 65, we had to do 66 for some reason. But today, I think it's over 67 for the people to start getting full Social Security. And you really have a choice whether to take it at your eligibility age or you can wait and take it even later if you want to. I don't know why people do that. I'm a money guy, so I want my hands on that money as soon as I can so I can invest it. A lot of people say, well, I don't need it, quote, now, so I'll leave it in there and let that monthly thing go. My whole premise, as in my book, my whole premise is you can grow that income quarterly, annually. You don't want it to sit there. You can grow it at a much higher rate than the change in the Social Security payment will be, because you have more sources of income to help you do that. You have 2, and they usually don't have any, because the trust fund left the building years ago. The Congress, our Congress manages to pay every dollar or spend every dollar that comes in. Doesn't matter what it was designated for or who put it there, they spend it. So.
So, we mentioned regarding, I think we had something similar with the cutting the grass, but I'd like to get to know you a little bit to kind of see your career. And then I know your father was actually in construction as well, so I've heard that in some show that you were on. So you may just give us a little synopsis of it.
Oh, yeah. Well, I got started, the first business I ever had or run was my own mowing lawns, and at that time, I had a side gig as well. I used to teach friends and others how to water ski, So, I had 2 things going, and my father was a real estate developer and vertical integration. You might have heard of vertical integration. Means you pretty much control everything that goes into your doing of your business. So he and his attorney owned a lumber yard, for example, so they got the materials cheaper, blah, blah, blah. They owned the land. They built homes. They took back the mortgages. They provided the insurance coverage for the house and the cars and all the other stuff. And one of the things I learned from what he did was the importance that he placed on the income generating activities in his program. He was making money through the lumberyard. He was making monthly income from the rentals. He was making money from the insurance payments. He was making money from the mortgage payments he was getting. So he told me, pretty much income is king. I mean, you can have all the wealth and market value, so to speak, or, homes and land and things like that are worth something. But all by themselves, they don't give you a penny to spend. And as he used to put it, I need a lot of pennies to support your mother. And so he emphasized for me that, whatever you do, you want to have a source of income that's growing. You want to have a source of income that's growing. And in fact, he made me give him like 25% of the money I was making mowing lawns and the other stuff. And he invested it for me. And when I was 25 years old, I got a manila envelope thrown on my table in front of me, happy birthday, and opened it up, and there were probably 40 different stock certificates in there. The days of stock certificates are long gone, but the idea is that I already had a portfolio of, actually today they'd call them dividend stocks, but they were all the big name. I would say probably half of them were in the Dow Jones average at the time. Companies you'd recognize like IBM and GE, and I think General Motors was in there, a couple oil companies, stuff like that. A couple that have gone under or disappeared, like Sears, were in there at the time. So that's where I got my start. And as soon as I deposited that with the broker, I started to see the dividends come in, and I started to study the stock market. And I never went into the real estate business with him because I got fascinated with what I was doing. And there are a lot of parallels between real estate investing and stock market investing that most people really never stop to think about. And in fact, I didn't really put it down in writing, so to speak, or really get my handles on it until I did a podcast a month or two ago with a real estate guy. And we were talking about the income that he focuses on with his rentals. And it's the same with me. I focus on the income I receive from the closed-end funds I use to invest in the securities markets. And he talked about flipping properties or, buying things when you can sell them right away, even rental properties and things like that. And I do the same thing. I have a target profit level for everything I buy in the stock market. So I'm flipping stocks and he's flipping real estate, so there's a lot of parallels between the mindset that goes into it. I prefer the market way of doing things because I don't have to have a plunger and keys and all the other stuff in the back of my car in case a tenant calls up and has a problem. I don't have to put huge sums of money into a new property to buy it, right? I mean, I can buy a stock, closed-end fund, 100 shares of stock for $4,000, I really. So, I don't have that same problem. I don't have to go to the bank for every transaction to borrow money and things like that. So I like that.
One of the big things is, and I know it happened to me a lot, is which property you can be asset rich and cash poor because you can't just sell it unless you want to really give it away, which nobody wants to do. And it's very hard to have cash flow.
Right. It's a liquidity problem. And with the stock market, they trade millions of shares a day. I mean, there's no liquidity in most securities. And the equity side is very liquid for the most part. There are some very few issues that don't have high liquidity, but that's rare. But the other side of the financial picture, the equity, is the ownership side of corporations. On the debt side, where they borrow money, the bonds, the preferred stocks, the short-term loans, liens, and things like that, and government bonds and things. Those things aren't so liquid. If you want to own a corporate bond issue, for example, you may not be able to, you have to ask your broker what's available, because people don't sell these things like they do. They usually hold them for the long haul because most people understand how they react to interest rates. But there is a market for them, but it's thin. And your broker may not be able to get you the price that, you have it in your portfolio and it says it's worth 102 a bond. You might have to sell it for 98 You know, if it's selling at, you may want, if you want to try to buy something that's under par, you might wind up paying more than par because they're taking a markup both ways. You know, so it's a whole different market. So what I discovered about 22 years ago were income closed-end funds, where they're professionally managed portfolios of hundreds, sometimes 1,000 or more, different corporate bonds or different municipal bonds or loan papers or mortgages. Any of these illiquid things are traded like stocks on the exchange. And that's what I've been using for my clients. I managed money for about 40 years, like I think you said. And I managed, when I sold my business last year, I had about 110 million under management. And probably 70% of that was invested in the, because of the age of my clients, many of whom are even older than I am, which is saying something. Were mostly in income securities for the intrinsic safety and the income generation. You know, so those that's where I really took that whole area out of the fixed income market. I created, in a sense, liquidity. I can go out and sell my bonds tomorrow at a market price, just like I can a stock. And that's a big, big plus in that area, the financial picture.
With an advisor, because like I mentioned about my pension, I had a bond as well. And I used to get these statements saying, if it goes up 6%, it's going to be worth this. If it's going up 8%, it's going to be worth this. And the next year they tell me the same thing, and it didn't really look like much was happening. You know, they were making money from it. With some of the managers and systems going in place, some charge a percentage of it. But what I've also seen, and I'm aware of, there's some, when it's being traded, whether sold or bought, the person is getting the kickback. It's like with your dad, with the, you know, all the different kind of things where you get money. I mean, I was doing that myself. I was doing currency exchange. I was doing insurance and organizing, which is great because you get money on the thing. But for the investor, because there's some out there and they're taking a percentage of their amount of money in there, but they're also kind of doing stuff like they're double dipping, whereas when they're buying and selling, they're taking a percentage. Is that regulated now, or is that the norm?
Well, it's changed. It's changed in the United States significantly. I don't know about Europe. I don't know if there is still such a thing as a commission in Europe. There are literally, unless you go to your online broker or whatever, and you actually call them up on the phone and say, help me with this, you can trade for free. Okay. In the financial services industry, advisors pretty much no longer do that double dipping thing. They no longer have a separate advisor like I was, that I was getting a fee and the broker was getting commissions when I trade. So between my fee and the commissions, the client was getting hosed basically. But that changed. After, even before the online brokerage firms came on, most brokers who did investment advice became fee only, where they would charge a point and a half, between 1.5 and maybe 2%. We never ever charged as much as 2%, but they would get an annual fee. So theoretically, in the advertising world of investment advisors, they say we only make money if you make money. But that they really should be saying is, we make more money when your market value goes up. We make less money when it goes down. But what they don't tell you is that their emphasis is investing in things hoping that the market value will go up, even if your needs as an old guy or as a person who's approaching retirement age, even if your need is really for an increased level of income to replace your salary. You know, that's what you want to see grow. Market value. On the cover of my book, I have a statement. Market value fuels the ego. Income fuels the yacht. You know, all you do when you raise somebody's market value is you increase your fees and you make them feel wealthy. But they can't take their brokerage statement to the cruise company and say, here, I got a lot of money. I want to go on this cruise. The cruise company's going to say, well, you're going to have to sell some of that, buddy, and give me cash in order to get on the boat. So the emphasis on Wall Street, the emphasis in the financial markets, in my mind, is kind of particularly for older people, people 50 and up, people who have to start, at least in the back of their mind somewhere, they're thinking at the time, you know, I want to have more money from my investment portfolio than my salary so I can say, goodbye, guys, I don't want to work here anymore. I'm going to go do my own thing. And the emphasis, the way Wall Street emphasizes growth and market value, that's not going to happen because you're never going to have enough income. If you were to open up 1,000 advisor portfolios for their clients, you would find that the average income being generated is less than 3%. And I know that because I've opened up thousands of portfolios from that had been managed by brokers and advisors where that was the case. And I'm doing that as I guess you call my retirement profession now, is to be an income coach to people and help them get more money from their portfolios than they're currently getting. So I see a lot of these situations where there's a very, very low level of income coming in on a very large portfolio. I also see a lot of other problems. Some of them are self-inflicted. I have great respect for investment advisors and their skills and abilities to protect clients from risk. Most clients, where they leave the fold, they say, well, but I just heard about this and I want to buy it. A broker really can't say no to that. He can advise against it, but he can't say no. Most advisors won't say no because they don't want to lose the client. In my case, I did it my way. And if the client didn't like it that way, I'd try to refer him to somebody who would go out there and buy that IPO for him or invest in Bitcoin if they want to, but I'm not going to do it for them, that type of thing. So fortunately, I had the luxury of being very particular that way.
Is there investment that basically, instead of charging like the 1.5, 2 points, that they work on a percentage of the increase? Because for me, that's what I'd prefer. That if you said,
yeah,
right, I'll take 20% of anything above, because even if it's level and you're taking, say, 2%, not you or some of them, you're actually losing as well as taking inflation into account. You're really getting...
Right. I understand that hedge funds can do that. Private hedge funds can do it based on how much they make you, and that's probably not a bad deal. What I used to do is I would tell my clients that with my methodology, because I'm a profit taker, I had targets for everything. I operated my portfolios like they were department stores. Everything was for sale at a specific markup. And I told them that I was pretty certain that in a normal year, I'd be able to make more than they paid in fees and capital gains. So on top of the base income, the dividends, the interest, the distributions they were getting on the securities, I would also make them at least the 1.5% that they were paying in fees to actually, in capital gains. But the fees they pay don't just go to the advisor. If you have a financial advisor and he's charging 1.85%, I mean, he's probably getting maybe 0.5%. There's the broker. If there's a separate broker and a separate broker dealer, they're both splitting the rest. If it's directly with a broker dealer and it's an employee of that broker dealer, the guy's probably getting about 3%. Is an employee? Maybe 3% of the 1.8 you're paying, and the house is getting the rest. So that's how it actually works. So so a portfolio of mine where in your head you might have been just saying if you were managing $100 million, you were making $1.5 million. That's not the case. You know, not even close. So that's the one thing. Your fees are not just going to the guy you have, and the guy you have, as much as he wants to help you, and I think most of them certainly do, he's required by his boss, the owner, to do certain things. Like there could be a requirement that a third of the money under management has to be in model portfolios, and we specify the model portfolios that you have to be in. Well, what's a model portfolio? A model portfolio is managed not by your guy, it's managed by somebody else in headquarters or somewhere. And they pick a portfolio of, let's say, 75 stocks that they say are designed for a person within 6 years of retirement. And then they'll have another model designed for a person who is early in his investment career and has plenty of time for retirement. They'll have a whole menu of different types of models. Most of them will contain the same securities. Some of them will be a little bit more speculative than others. The older you get, the more recognizable, successful dividend-paying companies will be in there. So it's not a bad thing. The bad thing is about it, it's still designed so that those guys are going to get their 1.5%. And that's based on the market value growth, not the income production. So you're not going to find any models that are going to pay you 6% or 8% or 9%. My portfolios right now are, because interest rates just went up and prices went down, my portfolios today are earning around 10% because of that. I mean, you're just not going to find that in a normal managed environment.
What because you mentioned about the capital gains, and I know with the property, there's ways of actually, deferring that and also putting it into a trust. Is it possible to use a trust for the capital gains in investments?
Well, you do have a couple options in that sense. You can put it into what we call tax-deferred programs like IRAs and Roths, and could be if your business has a individual 401k for you. I managed a couple of those. You can in a sense be putting the capital gains away, that type of thing. But for the most part, no. You're paying the taxes. What are the tax rates in Europe usually?
Not that varies so much. Like in Poland, kind of 18 to 30. But in Ireland, I mean, when I got a bond and everything, I got the 25% tax rate, but I took the rest at 50%. So
50%.
Yeah, and even I know some of the Scandinavians are even higher. So yeah.
Yeah, I know. Well, it all depends on what you're getting for your money, and you're getting free healthcare for one thing.
Well, in Ireland, you don't get much because people are on trolleys and everything. So yeah, they're and they've just from Ukraine they put 800,000 for all the animals. They're bringing the animals as well, but yet there's people living in cars, Irish people living in cars, and people in hospitals, and yeah. So
okay. But anyway, in the United States, I don't think the tax rate is ever up to 50. 35% is one of the higher brackets, I'd guess. So my emphasis let me just back up a minute. When you're in real estate and you own properties, the income is kind of fixed by the rentals and so forth, and the mortgage income, rentals and things. And it doesn't really matter if the price fluctuates, right? You're getting the same income. And in the stock market and the bond market, it's the same. It's the same way. And again, I get with that. Most people emphasize market value instead of the income. So it's the capital that produces the income. The amount you've put in there, you bought that place for 10 grand or that stock or that condo for 250, and it's the amount that you're getting in rent. That's the important thing. It doesn't matter if the price falls or the price goes up, if you're not thinking of selling it, you're still getting the same rent. And it's the same in the market. So so it's that capital that you've invested. That's the important thing. That's what's producing the income, not the market value. So if you take a loss or are afraid of taking a profit because of the taxes, and in our place, it's a 35% maximum, a 25% if it's long term. There's a distinction. You could say, I'm going to take $1,000 loss to keep myself from paying $350 in taxes. So I'm losing $1,000 in capital instead of spending $350 in capital. It doesn't make any sense to tax manage portfolio. I used to tell my clients, I said, look, if you're an individual investor and it's not an IRA or something, you're going to pay a lot of taxes with me because I'm going to make you a lot of money. So I said, and I jokingly would say, if you don't want to pay the taxes, take that money, pay it to me as a fee, and you'll deduct it and I'll pay you taxes, that type of thing. Because it made no sense, At that time, they could deduct investment management fees. Not anymore. They can't. So anyway, I was always joking when I said that. It wasn't real.
So you mentioned about Bitcoin before. So have you done any of the investments in blockchain? No.
No, I define the word investment differently than a lot of people do. Every investment involves risk. And in my mind, every investment should also involve income. And if it doesn't pay income, I'm not going to take the risk of owning it. And Bitcoin is one of those, in my mind, speculations that people get caught up in, like gold futures and gold bullion and stuff. Did you ever try to go to the pharmacy and buy a prescription with a block of gold? I don't understand how people get caught up in these things. It's really so easy to develop a well-diversified, safe portfolio of securities that generate a large amount of income without taking that kind of risk. People say that the kind of things I invest in have risk too, but they do. But when they developed mutual funds in the first place, they develop them so that the average guy who's now, this is back in let's say the 30s, 1930s, after the Great Depression, and they're trying to get the individual investor back into the market. And they were afraid because they didn't want to be one of those guys that was jumping out of windows, when the economy falls apart, So they came up with this thing, the mutual fund. It had been around way before, but it really got popular at that time because the little guy could get in there and he could own IBM, he could own the oil stocks and all those types of things just by owning a unit in this managed fund that a professional was taking care of for him. And that was a great thing because it really is one of the things that boosted the stock market from the Dow from like 1,000 to 38,000 where it is today was the impact of first the mutual funds and then the 401k type investing that the corporations were allowed to do for their employees. That's what brought the people back in. Well, way before that, this thing called closed-end funds were invented in Europe somewhere. My friends at Amsterdam tell me that they are responsible for the creation of this thing. And remember you were talking about a trust before? These are pass-through trusts where the management of the fund, of the trust, has to pay out 95% of its profits to its shareholders. So there you have an entity that's traded on the stock market like a common stock, which actually is paying you 95% of what it makes. None of the other vehicles do that. Mutual funds don't do that. ETFs don't do that. Only closed-end funds do it. And could you imagine if the big companies like what's the one that's making all the noise today that just turned in a good report and the market is up 2% because they were more profitable than they were supposed to be. It doesn't. I'm certain that company doesn't pay a penny in dividends. But anyway, what if Amazon had to pay 95% of its income to its shareholders? Wouldn't that be amazing? And it would be good for the economy too, actually, because those people would spend it. They're not going to spend it. They're going to buy more stores, or they're going to buy more buildings, or more books to put on there. But anyway, the whole idea of this trust is unique, because now I have these 200 different closed-end funds made up of, half of them are made up of equity, mostly stock market instruments, and the other ones are mostly bonds and mortgages and real estate. They're all paying, an average around 9%, and I can trade them every day just like stocks. And when these guys, like today, those managers are probably taking profits in all these companies that are going up, they're going to share 95% of the profits with the shareholders of the closed-end funds that I own. So that's where I am in that area. And as far as speculations, there are closed-end funds that do almost everything. There are now ETFs that do Bitcoin. I wouldn't go near them with a 10-foot pole because I'm old. I don't want to put my money in something that's speculative and it doesn't pay any income. And I'm an income-focused investor.
And are you finding, if somebody's cashing in, that, because I know that with the 50 states, that they all have their own tax laws and everything, which is kind of strange, but do people then move to where it's better for them, the lowest tax state, just when they're cashing?
Interestingly enough, my friends and I were having the very same conversation, and there are 2 states that we are considering, because South Carolina has an 8% income tax, which really annoyed me when I sold my business, because not only did I have to pay the feds, but I had, what I mean? But Florida is one with a 0 tax rate. And I think the other one was Kentucky or Arkansas or Tennessee, each of which have, attractive qualities. And so we actually went down to Florida and we were checking out some real estate down there. And property taxes are very, very high. I mean, the state, one way or the other, the state's going to get you. They got to get the money to provide the services, So I understand sales taxes, real estate taxes are high. There are some personal property taxes. So if you're going down there with your yacht is going to get taxed at a high rate, So, you're going to pay taxes one way or the other. So we've pretty much, we haven't made up our minds yet, but, who knows? 5 years from now, maybe I'll be in Florida. I don't know. But
so what mistakes do you see people making all the time that they shouldn't be making? Because obviously with your experience, you can see it, but if there are things that you see people are doing and you should say, oh no, don't do that.
Well, I would say from what I've seen, and I've probably done portfolio reviews and coaching for 75 people or so since I started. The things I see the most, bad diversification. I've seen people with $1 million portfolio spread over 3 securities. Maybe 3 mutual funds, maybe one of them an individual stock. I spoke to a guy the other day that had over $1 million in his old company's stock. A third of his portfolio in one company, and it's a company that doesn't pay any dividends, really. So you see the baldness I'm getting here. That's from pulling my hair out when I see these types of things. So diversification. I mean, I'm a fanatic diversifier. I like I said, I own over 200 different positions, and every one of those positions has an average of 200 or 300 securities inside it. So diversification, totally out of control with me. I am overly diversified, and I admit it, and I'm okay with that, because if any one of my securities goes to zero, can we name any securities that have gone to zero? Enron, Merrill Lynch. You know, I won't even feel a pinch, because there's nothing that I own even 2% of my overall portfolio. So, and that's how I used to manage the accounts that I managed. It was the same way. Overall diversification. That's probably the single most frequent error. The second will be income generation. It's just a function of the environment that they've grown up in. It's a market value focused environment, and all everybody cares about is, they don't even look at the income. You can't get a quote at my Fidelity program. When I plug in a stock to get a quote on it, the first screen that comes up doesn't even tell me the yield on that security. That's the most important thing to me, the yield. It doesn't even show it. It shows me how much the stock is up and down today. So it's one day, who cares? But you look for a mutual fund, Google a mutual fund and look it up. Try to find the yield on that mutual fund. It's hard. Some of them don't even show it. Same with ETFs. So it's just that focus. Nobody's telling them that income is king. Nobody's telling them. They're all saying, we made you this, your total return was 20%. Last year, your total return was 28%. But they didn't tell you that at the end of 23, all three market indicators were still below where they were 2 years ago. So what if you went up 28%? In the meantime, I've taken $100,000 in profits, and I've, been reinvesting my 9% earnings for those 2 years. Okay, so I've been growing my income. My market value is down. I don't care. It's still growing that income, growing that capital. I have more houses and hotels on my monopoly board now than I did 3 months ago. See what I mean? That's the difference in focus. So the focus is not on income. So that's the second mistake. And both of these things also, while we're talking about them, there are 4 ways to minimize your financial risk when you're an investor. There's quality, there's income, diversification, and profit taking. If you have targets for profit taking and do all the other things, your financial risk, your risk of having a security go under, has been minimized to the most you can possibly do. So quality, I do not find is a problem. Most of the securities that I've looked at in these hundreds of portfolios are good companies. I mean, like these model portfolios, which I always joke about, it makes me laugh just to think about them. They're all good companies. They're well researched or so on. Some of them pay minuscule dividends, but they're not income focused. But you can't say, oh, you're in big danger. It's the diversification was big danger, right? When they had more than 5% in one position. But typically in a model or in most of the portfolios I looked at, that's not a problem. The quality. They're all good quality. Just as some quality companies do pay income and some don't. You could have a portfolio of municipal bonds where you have all those problems of liquidity and so forth, and you're getting 3%, 3.5% tax free. But you do have that liquidity. Your payments are semi-annual and instead of monthly. Where you can buy closed-end funds with hundreds, literally hundreds, even in your own home state. You can buy them with hundreds of securities with an average yield well over 4%. Well, right now the yield's over 5%, and have instant liquidity in the stock market because they're traded like stocks. So there's different ways to get the job done. Profit taking then is the other one. You'll find people who get to retirement and they still have this stock or stocks they inherited from their parents in their portfolio. I remember once, very early in my career, where I literally drove up from South Jersey with a lot of Exxon, SO, I'm not even sure if it's Exxon yet, Exxon certificates in my briefcase, over $1 million worth, that this guy had gotten through a pass-through trust. That was his entire inheritance. Like, it had to be, I don't know, maybe 1.4, 1.6 million. And we put it in the brokerage account, and the average cost on these things was like $1.95. And the stock price was, like in the 50s, I think, something like that. So this was his only money. He wanted to buy, hey, I'm rich, I want to buy a new house. Well, in order to buy a new house, he had to sell, in those days, $250,000 worth of the stock. Well, the $250,000 worth of the stock, of that, $225,000 of it was taxable. So then he had to sell more stock to pay the taxes. And then, of course, he had to sell more stock. You know what I mean? So he was just in this vicious circle of, even though Exxon paid a reasonable dividend, it wasn't enough for him to change his lifestyle as a new millionaire would want to do without having this huge tax burden. So anyway, he started looking around, and he found someone who sold him, unbeknownst to me, he sold him some private master limited partnerships of some kind. I forget what they called them in those days, but I don't think they're legal anymore. So he did this because he could do this somehow and have a tax write-off from it. Well, he did. He got a tax write-off by losing all his money in it. But in any event, so that's the kind of things you bump up against when you're looking at these portfolios. These heirloom stocks, these things that people have held forever. I had a conversation with a guy the other day, and he said, yeah, I recognize that, and I'm going to slowly get rid of them. He had about 10 years to retirement. I think I'm going to save a share or two of each one just because. I said, go out and buy 5 of these closed-end equity funds, and I can assure you that they own some of that stock. You don't have to own one share. You can own thousands of shares as an owner of this portfolio of securities. So, it's different. So, those mistakes, not taking your profits is a biggie, not only because it puts you in a position that you're going to have to pay a lot of taxes later, but let's think of how you generate income. There are 2 streams of income. And the one is the dividends and the interest you get. Some of the closed-end funds, you're even getting income from covered call options, because they're the only safe form of option trading, right? So you can get income from several sources, but you're getting this every month. You're getting this safe income. And then there's the capital gains, that stream of income. So every time you take a profit, you're adding, that profit becomes new capital. You're creating capital that you can reinvest right now at, 8, 9, 10%. So you make an effort in a market that's been a market that's been beaten down by higher interest rates, and you can get these great prices. You don't find too many profits. So when you get them, you take advantage of it and increase. And you also have the equity side of your portfolio, which is now producing profits because that side of the portfolio is going up. So you can then take those profits and keep your asset allocation properly. And so you're adding this extra money. And say, for example, your portfolio generates 25,000 a month from all these. I'm talking about a large portfolio, obviously. 25,000 a month in dividends. And by just taking small profits throughout the first 6 weeks of the year, you've been able to generate nearly 30,000 in profits. That's totally separate from that 25,000. So in effect, the year is now 13 months of income, right? You generated another year's worth of income in 6 weeks. And I've done it, so I know it's doable. I have Facebook groups where people are, they go on there and they brag about the fact that they've made another month's income through profit taking. So that's the second source of income. I call it my rich uncle, basically. I look at the market. The market's up. It's going to be up. According to the futures, it's going to be up significantly today. I'm going to take profits. That's my rich uncle. He's saying, here, take this money. It's yours. And that's what you got to do. If you have that profit-taking discipline, you can add to your income and grow your income so that by the time, as I was when I was 30, when I got that pile of securities, 7, 8 years later, I said goodbye to my employer because I was making much more money on my investment portfolio than I was making in salary.
And with the dividends then, like, what are the top paying ones at the moment? Like, say, the top 5. What's the percentage as an investment side of things?
Oh, I mean, you can find these closed-end funds that are paying in the teens, 15, 14. And you have to look at them with, you have to go inside and see how are they doing this. But when you look at it, recognize that how many times in our lifetimes have interest rates gone from 0 to 5% or changed by 5% to the upside in the space of 18 months? Almost never. The cycle is usually much longer. So a lot of these interest rate sensitive securities containing bonds and notes and things like that, the prices of those securities inside have to go down with the rising interest rates. Okay? And a lot of people sell them because they think this net asset value reduction is dangerous for some time. They don't realize, wait a minute, these are bonds, good company bonds. The company has to pay them back at full face value, so that what they're worth today is not nearly important. They're still paying the same income. So these things the prices go down and the yields go up on these perfectly decent bonds. And that's why the prices are so high. But you look inside and you see if there's anything else going on. Look at their price chart. See if it's really tumbled more than the normal, or if the dividend they are paying has changed in any way. If you look at most of these, they paid the same level pretty much of dividends for 20 years, So I do that type of analysis every month. I look at all the securities I own, what their dividends, current month dividends are, how it relates to the past dividends and so on, just to check that out. So you can determine if yields are high just because of interest rates going crazy or if there's something else going on. So you have to do your due diligence in any kind of investing, particularly in my position where I'm talking to other people about it. But, I find that universe of securities at 200 some are plus pretty much stays about that number right now, as it always is. But yeah, you can't just go out and say and put them all in order and say I'm going to get all those top ones. That's not good diversification either. You want to diversify. There are maybe 50 companies like BlackRock, Nuveen, Eaton Vance, Gabelli, all these very, very huge financial companies that offer these closed-end funds, and they don't advertise them, but they're there. And you spread your I spread the investments among all of them, and all of them, all of them behave pretty nicely. Only very rarely there's only one that's on my list of I will not buy any more of this one. And but anybody who works with me will see that it's not on my list, so they'll know. You know, so it doesn't happen often. It doesn't. I mean, BlackRock's probably one of the biggest companies in the world as far as financial services is concerned, and managing other people's money. And they're one of the biggest providers of all three kinds of closed-end funds: the tax-exempt, the taxable, and the equity. And I do own a lot of BlackRock and Nuveen, all the ones I mentioned, and others, and several others. Probably about 40, 45, 50, I don't know, something like that.
And just finally, you've got the two books. You've got The Brainwashing of the American Investor, and the other one is The Retirement Money Secrets. So you may just kind of briefly say what's in it so that people will know what to...
Well, the Brainwashing book was primarily focused on individual equities, what people today would call dividend stocks, because I'd never buy a stock that, didn't pay a dividend. I never bought mutual funds and new issues and things like that. So that's what it focused on. And it gave all the other stuff's the same: the quality, diversification, income, profit taking, the market cycle, and the focus on income. Everything else is the same. It's just I was using stocks for equities at that time. And I did that pretty much up until the financial crisis. I'd already switched over to closed-end funds for my income investing side. And I had started to pick away. I always had some equity closed-end funds, like some that had been around for hundreds of years. But I stopped doing the stocks because they no longer, we had like a 12-year rally. And by 2010, I couldn't find anything to buy because of my rules. I had rules that I wouldn't buy anything unless it was down 20% from its 52-week high. They just weren't getting down there. And then when you did find one that was down there, you had to scratch your head and say, if this one's down there and everything else is up, something's got to be wrong. So you wouldn't buy it anyway. So I changed. And I said, the guy I worked with and we tried to come up with a new way of figuring out getting the same fundamentals. We were fundamentalists. We weren't technical people. We don't try to predict the future with the history of the past. We go on the fundamentals of the companies. Are they profitable? Do they pay dividends? Blah, blah, blah. So I couldn't find anything anymore. So I started going more and more and more into closed-end funds. And in the book, in the back chapter, I have a illustration of a guy who I was managing money for, who was primarily in the stock market for his equities. And it shows the history of how I gradually moved him into closed-end funds. And you'll see how the income just goes crazy, and the working capital that he has invested just really went, nuts over that period of time just by changing to the higher income vehicles. So that's what the brainwashing was there. Retirement Money Secrets is like why I transitioned and what I transitioned to, and why I still have exactly the same dividend stocks in my portfolios, but I have it in a much safer package, because the package is the same as a mutual fund package in the sense of what it contains. The difference is, like I said, it's a pass-through trust, right? All the income comes to me, and it trades like a stock. So they don't have to wait for overnight pricing or anything like that. So that's the difference between the two books. The brainwashing book, don't go out and buy it. It's free, as you know. At my website, when you get there, there's a thing called freebies. The brainwashing book is one of those freebies. So all you got to do is ask and you can have it. The other one, you got to pay a very small amount of money for, which probably will be worth it to you.
Yeah, excellent. Listen, thoroughly enjoyed the conversation, Steve. You might let people know where they can find you.
They can find me at theincomecoach.net. That's where it explains what I do now. And there's also a link to the book. I'd prefer it if you have read the book before you come and talk to me about investing, because otherwise we'll probably have to have several conversations to get you to that point. And it'll save you money if you read the book first.
Excellent. I'll make sure I put the link on the audio and the video. Thank you very much, Steve.
Okay, appreciate it. Great talking to you.
So that's all for the Speaking Podcast. You can, well, I didn't help when my camera just cut off, but that's all for the Speaking Podcast. You find all our episodes on speakingpodcast.com. Until next week, take care. So I hope you enjoyed this week's episode. As mentioned at the start, you'll find my 6 podcasts on bio.link/podcaster. And also, if you'd like to start a podcast or do a podcasting tour, you'll find the information on that or on the QR code that's there. Be sure to give us a thumbs up, 5-star rating, and share with your friends because it really helps. Until next week, take care.